Happy New Year and welcome to my 2020 housing forecast. I'm Kathy Fettke, co-CEO of Real Wealth Network, and I'm going to be giving you some ideas about what I think is coming based on a lot of the economists that I interview on the Real Wealth Show and a lot of the articles I read and a lot of people I talk to who are in the industry. I'm kind of obsessed with the topic. By no means does it mean I've got the answers. I've got this disclaimer that I do not actually have a crystal ball. I want to be very clear about this. This crystal ball is actually an ornament from my Christmas tree. So, so just use my research to help with your due diligence and only get tax advice from your tax advisor. And just know that my predictions could be wrong. We have no idea what is actually going to happen. So don't rely on the information I share. Just use it to help with your research. And the key really to success is taking 100% personal responsibility in any decision that you make. It's incredible how that frees you up from wanting to blame other people. We've been really trained to trust other people with our finances, whether it's our financial planner or maybe our spouse or whoever it is we think is going to take care of us. But really, in the end, we are the ones who are the captains of our financial future. We really have to look at this like nobody else is going to care about our money as much as we do. So just remember, your decisions are what matter the most. So I'm going to share a lot of slides today on the current state of the US economy. And at the end, I'll just kind of leave it up to you to decide what you think is the best thing to do with your money and the safest place to put it. So what we've seen is we have a growing but slowing economy. The GDP is going to land around 2%. So it's an interesting thing to see that we've created a whole lot of debt, which I'll show in future slides, but we haven't really seen the GDP grow as a result of that. So that's a little bit concerning. Still, with that said, we're not in recession territory right now. So all this talk about a recession is kind of a waste of time because we're not near it right now. Maybe in the future, but probably not in 2020. So that's good news. We have seen job growth over the past 10 years, and I'm basically showing slides from the past decade. The tens. So when we go back to 2010, wow, things were really bad, really bad. If you can remember what life was like in 2010, it was really scary. Look at the job growth back then, pretty pathetic. And then certain government stimuluses brought us back, and really that's the quantitative easing, the pouring of trillions of dollars into the economy worked, propped us back up again. You can see it in the low unemployment numbers. We're at very, very historic lows. And look at that, 10 years ago, it was pretty bad, pretty bad. Wage growth, look at that, 10 years ago, not too impressive, but we have seen some pretty steady wage growth. Certainly all of this positive news has affected the stock market, and the NASDAQ's been up, 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 and home prices. So if you were really just to look at a snapshot of the US economy, it looks pretty good, and that's why we see a lot of consumer confidence today. We're basically looking at where do people spend their money, because our economy is really based on people like you and me just spending money, and we have to be confident that it won't be our last dollar if we're going to spend it. So this is a really important metric, especially when you look at if people are spending on extracurricular things like leisure, spas, restaurants, and they are. Entertainment is up. So that again is a sign that either people have zero self-control and are spending their last dollar, or they're just really confident that things are going to continue to get better. So you might say, well, my goodness, let's just party like it's 1920 in 2020. And that's a little scary because we all know what happened at the end of the 20s, right? We had the Great Depression. And that's what's a little confusing, and probably why so many people are a little bit freaked out, because there's so often a boom right before a bust. And in the past, so many people, millions of people, most people never saw it coming. And there's always a certain group of what we might call the smart money who does see it coming, and they move assets. They reposition things in preparation for that downturn, and they often benefit and make money during a downturn. But the masses do not. The masses rarely see it coming because they're only paying attention to headlines and to looking at the past. And literally, if you looked at the past 10 years, you would think there's no problem. And a lot of people act that way today, like things are only going to continue to be great. But when we look at this chart of recessions, we can see that things are great, and then there's a recession, and it takes many people by surprise. And then there's stimulus and usually by the Federal Reserve, and then things are good again until they're not. But what is it that causes these recessions when most people don't see it coming? Things are going great. It tends to be some kind of event there's been a buildup for it, but people can't see it until it explodes. We know that in the 70s there was oil embargoes, and in the 80s the S&L crisis. I can't remember what happened in the 90s, but I'm sure some of our listeners do, and you could put it in the notes if you remember. Of course, in the early 2000s, we know it was the dot-com bust, and then nobody can forget what happened in 2007 and 8 with the housing crisis and collapse. Now, these were all different triggers that caused recessions. So how will we know what that next trigger is going to be? What is it? Because nobody wants to get caught off guard. I know I don't. I know you don't. We are getting older. I should say I for sure am getting older, and probably most of our listeners never want to go through a downturn again. We just simply can't afford that. When you're getting later in life, you don't want to start over. So what could trigger that next recession? And how would a recession affect our industry, the housing industry, and the rental market? I'm assuming most of the listeners here today are real estate investors, and specifically in single family rental homes. So that's what we're going to be focusing on, a little bit of apartments as well. So what's coming, and how can we prepare for it and not lose like in the past? So here are some possible triggers, and possibly not the triggers. We really won't know, but some of the issues that we're facing today is a massive federal deficit, $1 trillion a year of expenses that we can't cover. Now, what happens when you have more expenses than you have income? Well, you create debt, and that's what we've got. Basically, we're spending $1 trillion more every year than we have coming in income, which is especially concerning since we just had, the tax cuts, and we've had stimulus. These are things that normally you will only do in a down market. We've had an up market for 10 years, and yet we still had tax cuts to stimulate the economy further at a time when you normally wouldn't do that. And that's causing, these deficits. So normally when you're stimulating an economy, that would create more income, more jobs, more taxes coming in that would cover and offset the debt. But we're not seeing that. Instead, we're seeing a growing deficit. So what's going on? Well, when you're losing $1 trillion a year, I mean, think about it. If you had a business that was losing $1 trillion a year, that would not be a great business. And probably few people would invest in it. But people still are investing in the US. It's interesting. And so when there's a $1 trillion difference every year, well, that goes into the federal total public debt. And that just keeps rising year after year after year. It's debt that we owe that nobody really, really knows how to pay back. But we're still spending like crazy. So I don't know if you've ever, well, you see it all the time now, companies like WeWork that just keep borrowing money, keep, not really paying attention to the losses until it all blows up. Now, why has debt soared since the 70s? Well, back when Nixon was president, there was this problem where money was tied to gold. We were on the gold standard. So the government could only spend so much money or go into so much debt that was tied to the amount of gold we had. Well, that's no fun, because when you're a president and you want to stay president, you got to make lots of promises and you got to pay for those promises. And if there's no money, you don't get reelected. So Nixon took us off that gold standard. And basically, our money, our Federal Reserve could print money without being tied to gold for the first time. And that just really took off. And politicians realized it is a lot of fun to spend money. It makes the job easier. So you see every year there's more money spent because you see it's easy to get that debt. If you could borrow $1 trillion, you might do it, especially if no one seemed to care if it gets paid back. So the question is this party sustainable? Can we keep borrowing money? Can we keep going in debt? Can we keep having this massive growing deficit and not worry about it? What's interesting is in the past, the Republican Party was kind of known for being fiscally conservative and trying to stay out of debt. But when you really look at the numbers, it's just not true. Republicans and Democrats alike are really enjoying spending money. And maybe they have to keep the economy going. Maybe it's a Ponzi scheme that just won't stop until it stops. But you can see here, it is party agnostic. Everybody likes debt. Everybody likes spending money. All politicians like making promises that they need to keep in order to get reelected. And when you have access to lots of money that you can just borrow to make those dreams come true, well, they're going to do it. Now, the problem is debt to income. Like I said, as investors, we love debt. Debt's a great thing. If you can borrow money to buy an asset that creates income and that income pays off the debt, well, that's a good deal. And that's what we do in real estate, right? We borrow $100,000 to buy a $120,000 home, and the rents come in and help us pay down that $100,000 debt, and that's good debt. So how is it with the government? Are we borrowing debt that's producing enough income to cover it? No, we're not. As I said earlier, we have a deficit. We're not covering the gap, but borrowing more. And that debt to income it's most creditors don't worry until the sovereign debt is more than 77% of GDP, and that's according to the World Bank. Well, the US debt to GDP ratio was 107%. So that's getting into scary territory. Yet it doesn't seem to be stopping people from buying US treasuries and US debt. It seems that the US is, in many investors' minds, the safest place to buy debt because other countries maybe are offering negative returns. And so, of our $23 million in US debt, about 17 of it is public debt. That's money that we owe to investors. So that's interesting. I wonder if those investors will all get paid back. We'll see. Right now, there doesn't seem to be a way to pay them back. I heard that we'd have to get GDP up to 9% to even begin to make those payments. And we're not close to that. So basically, again, if we go back to the 70s, we couldn't just print money randomly. Well, now we can. You could see it really got out of control starting in the Great Recession, and we've been doing it ever since. This is just basically printing money out of thin air, throwing it into the economy. And when you have that much money circulating, trillions of dollars, well, you better hope that that's going to drive the stock market up and that we'll see results of it that'll drive housing up. And we have. It really did pull us out of that Great Recession. But now we're in territories that we've never been in before. This is an economy that has not been tested. So it's important to keep that in mind as you move forward in making decisions. Now, people like Warren Buffett argue that government budget deficit just doesn't matter, that there's no evidence in American history that it really matters. So, I'll tell you, Warren Buffett is a much richer man than me, much better investor than most people. So if he's not worried about all this debt, maybe we shouldn't be either. But with that said, there's one thing I know, and I know that bad debt takes companies down. It takes families down. If you take on too much debt and you can't pay it back, you're going to go bankrupt. We've seen it happen in Detroit and Puerto Rico. You just bad debt can take you down. Obviously, if we are buying a bunch of homes on with loans and we can't rent out those properties and we can't make the payments, they're going to foreclose on you. So the difference is that in the US, we can just keep printing money. And that's what the central banks worldwide are doing. Now, I don't know that this has really been tested in the past. What we do know is countries like Germany, who just printed lots and lots of money, it didn't go well for them. So far, we're okay. But again, we have to keep this in mind that what can we do to protect ourselves? We can listen to Warren Buffett and say, cool, let's not worry about it, but maybe we should still have some protections in place in case he's wrong. Now, the second thing we need to pay attention to is interest rates. What we know for sure is that real estate is affected by interest rates. Now, not always the way we think. For example, during the Great Recession, interest rates were so low, and yet people still weren't able to borrow the money because they had bad credit or they had no money, no job, whatever, in recessions, even when interest rates are low, it can be really hard to buy. Now, when interest rates are high, it may not affect the market either. We can look here in the 80s where interest rates were really high, but we didn't have a housing recession. People were still buying homes. So it doesn't always correlate, but when affordability is already maxed out, and interest rates go up, that's when we have big problems. When wages are not keeping up with the rising home prices and interest rates go up too, then it's a problem. And that's what we saw at the end of 2018 when the Fed had raised rates and the economy was really moving along and home prices were going up and the stocks were going up. And the Fed thought, okay, we need to slow down this economy and raise rates. Well, that did slow down the housing market across the country. So President Trump was not happy about that. So last year, right around, well, pretty much all of last year, President Trump was fighting with the Fed to lower rates again. And about halfway through the year, the Fed did it. They reversed their policy, and instead of raising rates to slow down the boom, they lowered rates to stimulate the economy, and it worked again. So just this fall, we've seen the stock market go up again as a result of the confidence from this kind of stimulus, and more people could afford housing. So we've seen sales go up and prices go up. So we know that real estate at this phase in the cycle is really affected by interest rates going up. So will they? Well, who knows? We don't know for sure, but everything I'm reading, it shows that the Fed has stated there's no plans to raise rates. They're just going to hold steady, probably for the rest of the year. If President Trump has anything to say about it, he's going to really make sure that happens because he wants to stay president. And raising rates would not help his cause because it would slow down the economy. So my guess is we're going to see rates stay where they are for the rest of the year. Now, what will they do after that? I don't know. But at some point, rates will probably stabilize to an average. As you can see here, it might be 6, 7, 8%, which is a little bit more normal. So today we still have this incredible opportunity to lock in fixed rate loans, 30-year fixed rate loans at low interest rates that really increase cash flow. When your mortgage payment is fixed and yet you have rising rents on your properties, you basically get increased cash flow every year that you raise rents, but your mortgage payment stays the same. So it is really a wonderful opportunity now to take advantage of the low interest rates, lock in a rate for 3 decades, and you know that in that time, the rents on your properties will be going up.